Many people assume that simply owning gold or silver automatically shields them from financial upheaval, that just having some exposure puts them on the safe side. History, however, tells a very different story. In every major monetary transition, those who believed they were prepared often found themselves underprepared. Not because they held the wrong assets, but because they held too little, held them in the wrong way, or misunderstood what those assets were actually meant to do when the system came under real stress. As we approach 2026, this distinction is becoming increasingly crucial. The environment ahead is not a typical economic slowdown. It is a structural transition that touches debt, currencies, liquidity, and trust. In such a setting, vague exposure is far from true protection. This conversation matters now, not in hindsight, because effective positioning for safety must happen before the stress becomes obvious, not after. By the time most people feel unsafe, the window to position correctly has already closed. The critical question is no longer whether gold and silver will matter in 2026, but how much is genuinely enough to make a difference. There is a huge difference between owning metals symbolically and owning them functionally, and it is in that gap where many are caught off guard. To understand what enough really means, we first need to clarify what gold and silver are actually protecting against. These are not magical assets. They won't stop volatility or erase risk. What they do is safeguard purchasing power during monetary disruptions, policy errors, and confidence shocks. They function as monetary insurance, not as engines for growth, and like any insurance, they only work if sized appropriately relative to the risk they are meant to offset. The risk profile heading into 2026 is very different from the typical recession scenarios most people imagine. This isn't simply about slowing GDP or rising unemployment. At its core, the challenge lies in debt saturation, compounded by mounting political pressure on monetary policy. Governments are now carrying debt levels that simply cannot be managed without either persistent inflation or forms of financial repression. Central banks find themselves caught in a difficult bind, having to balance the protection of currencies with the protection of markets. History shows that when forced to choose, markets almost always take priority, and that choice carries real consequences for savers. When real yields are suppressed, currency purchasing power erodes, and financial assets become increasingly dependent on policy support. Tangible monetary assets begin to take on a far more significant role. Gold transforms into a credibility hedge against currency debasement, while silver serves as a hybrid hedge, sensitive both to monetary stress and industrial demand. This dual nature is precisely why silver behaves differently than gold during transitions, and why holding one without a clear understanding of the other's role can create imbalance. One of the most common mistakes people make is thinking in percentages without context. They hear rules of thumb like 5% in gold or 10% in precious metals and assume those numbers are universal. They are not. Allocation isn't about copying a model portfolio, it's about aligning exposure to the level of risk you face. Someone with high leverage, minimal savings, and income closely tied to the financial system requires a very different allocation than someone with low debt, diversified income, and strong cash flow. Enough is relative, but it is far from arbitrary. Another frequent misunderstanding revolves around time horizon. Gold and silver do not shield you from daily market swings, they provide protection across cycles. Those who panic and sell during drawdowns are often the same people who bought metals for the wrong reasons. Protection assets are inherently uncomfortable when held correctly. They are not designed to make you feel wealthy during bubbles. Their purpose is far more critical, to ensure you are not wiped out when those bubbles inevitably burst. As we move closer to 2026, multiple structural pressures are converging. Government refinancing needs are accelerating, interest costs are consuming increasingly large portions of national budgets, and political cycles are intensifying pressure on central banks to prioritize growth and employment, often at the expense of currency stability. This confluence of factors is creating a backdrop where tangible monetary assets are not just relevant, they are essential. At the same time, global confidence in reserve currencies is being tested by sanctions, trade fragmentation, and shifting geopolitical alliances. These aren't abstract risks, they're already visible in policy decisions and market behavior. Central banks are signaling this shift more through their actions than their words. Even at elevated prices, they continue to accumulate gold not because an immediate crisis is expected, but because they are reducing exposure to counterparty risk. When the very institutions that issue currencies choose to hold an asset that cannot be printed, it sends a clear message about how they view the future. Individuals would do well to pay attention to that signal. Silver adds another layer of complexity. Unlike gold, silver is consumed. It is integral to energy infrastructure, electronics, medical applications, and defense technologies. As industrial demand grows while supply remains constrained, silver's dual role as both a monetary and industrial asset introduces volatility but also opportunity. That volatility cuts both ways, which is why proper sizing is even more important for silver than for gold. So, how do you think about enough in practical terms? It begins with defining what you are trying to protect. If your goal is to preserve purchasing power through periods of elevated inflation and currency weakness, gold tends to do that more reliably. If your objective also includes capturing potential upside from monetary stress combined with industrial scarcity, silver becomes increasingly relevant. But neither should dominate your financial life to the point where you are exposed to unnecessary volatility or liquidity risk. Liquidity is another often overlooked factor. Metals, especially physical metals, are not always as liquid as cash or equities. That characteristic is both a strength and a limitation. You don't want to be forced to sell protection assets under stress just to cover short-term needs. Metals should complement an emergency buffer, not replace it. People who skip this step often find themselves forced to liquidate metals at the worst possible moment. The question for 2026 is also about sequence. The order in which events unfold can make a significant difference. Inflation may arrive in waves, policy responses may lag, and markets may swing unpredictably between complacency and panic. Gold and silver tend to react differently at various stages of this process. Gold often moves first during confidence shocks, while silver typically accelerates later as liquidity expands and inflation becomes more apparent. Understanding this sequence helps prevent emotional, reactive decisions. There's also a psychological component to holding metals. It requires conviction because there will be long periods where they appear stagnant while other assets outperform. That is the true cost of insurance. Those who cannot tolerate that discomfort often abandon their positions just before the assets become valuable. This is why enough is not merely a number, it is an amount you can hold without constantly second-guessing yourself. For some, it might mean having enough to cover a year of basic expenses if the currency weakens significantly. For others, it might mean protecting a portion of long-term savings from financial repression. There is no single answer, but there is a clear wrong one, assuming that minimal exposure will somehow scale when stress arrives. It won't. Another common mistake is anchoring decisions to nominal prices rather than real outcomes. People ask whether gold at a certain price is expensive without considering what that price represents relative to currency supply, debt levels, and purchasing power. In a world where money is being created faster than goods and services, nominal prices lose meaning. What truly matters is what an asset can buy over time. As we move closer to 2026, the margin for error is shrinking. Adjusting allocation early is far easier than scrambling under pressure. This doesn't mean going all in or making dramatic moves, it means being intentional rather than reactive. The people who navigate transitions most successfully are rarely the ones who predict perfectly. They are the ones who position conservatively, remain flexible, and stick to a strategy built to endure uncertainty. This is why combining gold and silver thoughtfully is so important. Gold brings stability and credibility, while silver offers optionality and leverage to monetary stress. Together, when used strategically, they can balance each other. Used poorly, they can magnify mistakes. The objective is not to chase maximum returns, but to minimize regret. To move from theory to practice, it's essential to translate this understanding into realistic frameworks. Simply knowing that gold and silver matter isn't enough. Knowing how much to hold and why is what truly makes the difference. Without structure, preparation easily becomes guesswork, and guesswork is exactly what fails when stress hits. The first thing to understand is that there is no universal allocation that works for everyone. However, historical experience provides ranges that have consistently offered meaningful protection during periods of monetary stress, inflation, and financial repression. These ranges are based on real outcomes, not opinions. Looking back at prior monetary transitions from the inflationary cycle of the 1970s to emerging market currency crises, and episodes of financial repression in developed economies, the individuals who preserved purchasing power were not those with token exposure. They were the ones who held a meaningful portion of their net worth and assets independent of the financial system. For most people, meaningful does not mean extreme. It doesn't mean betting everything on metals or abandoning productive assets. Instead, it means allocating enough that the performance of these assets can offset losses or stagnation elsewhere. Historically, that range has often fallen between 10 and 25% of net worth in precious metals, depending on individual circumstances, debt levels, income stability, and geographic exposure. This is the kind of framework that turns abstract preparation into tangible, actionable protection. Below that range, metals may feel psychologically reassuring, but financially they remain largely irrelevant. Above that range, volatility and liquidity constraints can become problematic, particularly for those who rely on their portfolios for cash flow or near-term expenses. Within this broader range, the balance between gold and silver becomes crucial. Gold generally serves as the anchor. It is less volatile, more liquid globally, and more directly tied to monetary credibility. Silver, on the other hand, is more volatile and more sensitive to both industrial cycles and speculative flows. Because of this, gold primarily fulfills the role of preservation, while silver acts as a potential amplifier. That doesn't mean silver is inherently riskier in every context, but its swings both upward and downward tend to be larger. For many investors, a gold-heavy allocation within their metals exposure provides stability, while a smaller but meaningful allocation to silver offers optional upside if monetary stress escalates. A common framework among conservative allocators is roughly 2/3 gold and 1/3 silver within the precious metals portion of the portfolio. This balance has historically reduced volatility while still allowing participation in silver's upside during periods of inflationary pressure or supply constraints. More aggressive allocators may tilt closer to a 50-50 split, but this comes with the understanding that drawdowns will be sharper and patience will be tested more severely. The objective is not to maximize potential returns, but to align exposure with temperament, because even the most thoughtfully designed allocation is ineffective if abandoned under pressure. Another critical consideration is the form of ownership. Physical metals behave differently from paper representations, and this distinction becomes increasingly important as systemic stress rises. Physical gold and silver eliminate counterparty risk, but introduce challenges around storage, insurance, and liquidity. Paper instruments, by contrast, offer convenience and liquidity but remain dependent on the stability of the financial system. Understanding these nuances and structuring exposure accordingly can make the difference between meaningful protection and a false sense of security. Many people don't fully appreciate how these differences matter until it's too late. In environments where trust is eroding, the value of direct ownership becomes far more apparent, but that doesn't mean all exposure must be physical. A layered approach, combining physical holdings with carefully selected financial instruments, can provide balance, flexibility, and security. It's also crucial to think in terms of function rather than labels. Ask yourself what role each portion of your allocation is meant to play. Is it designed to preserve purchasing power over decades? To provide optional liquidity during a crisis? To hedge currency or geopolitical risk? Answering these questions honestly brings clarity to both the size and structure of your metals allocation. Without that clarity, people often end up chasing performance rather than seeking true protection. The time frame heading into 2026 adds a layer of urgency to this analysis because many of the pressures building today are cumulative rather than cyclical. Debt levels are unlikely to meaningfully decline. Demographic trends are driving rising entitlement costs. Political incentives often favor short-term stability over long-term fiscal discipline. Together, these forces suggest that policy responses will continue to lean toward inflation and financial repression rather than austerity. In such an environment, assets that rely heavily on policy credibility grow riskier, while assets that exist outside the policy framework like gold and silver become increasingly valuable as hedges. One of the most underappreciated risks heading into 2026 is the erosion of real returns. Even if nominal asset prices rise, inflation-adjusted outcomes may disappoint, particularly for savers relying on traditional fixed-income instruments or cash-heavy portfolios. Gold and silver do not produce yield, but they protect purchasing power when yields are artificially suppressed. In a world where real yields remain negative or unstable, the opportunity cost of holding metals decreases even if nominal rates appear attractive. Another important consideration is volatility clustering. Periods of calm often precede sudden instability, and markets tend to underestimate just how quickly conditions can change. Recognizing this dynamic is key to positioning metals effectively as part of a broader strategy for resilience. Gold and silver often respond not to slow, gradual changes but to sudden realizations. That's why waiting for confirmation can be costly. By the time the need for protection becomes obvious, the price of that protection has usually risen. Preparing gradually, rather than reacting under pressure, reduces both financial and emotional stress. There's also a geopolitical dimension that cannot be ignored. The fragmentation of trade, currency blocks, and payment systems increases the value of neutral reserve assets. Central banks have already acted on this reality, increasing gold holdings not because they expect immediate collapse, but to reduce reliance on assets that carry political risk. Individuals face similar, though smaller-scale, considerations. Diversifying away from dependence on any single system helps reduce vulnerability. Another common mistake is treating metals as a trade rather than a position. Trading demands precise timing, discipline, and emotional resilience, while positioning relies on patience and clarity. Those who constantly adjust metals exposure based on short-term price movements often fare worse than those who establish a thoughtful allocation and rebalance occasionally. The goal is not to outsmart the market, but to remain solvent and flexible across a broad range of outcomes. Rebalancing is an important, yet often overlooked, discipline. As metals perform well relative to other assets, their share of a portfolio naturally increases. Trimming and reallocating at that point can reduce risk without abandoning protection. Conversely, when metals underperform, modest additions can restore balance. This systematic approach removes emotion from the process and aligns behavior with long-term objectives. For those worried about starting late, it's important to remember that preparation is not all or nothing. Being partially prepared is far better than being completely unprepared. The worst position is paralysis. Markets don't demand perfection, they reward prudence, foresight, and consistency. Spreading adjustments over time reduces both timing risk and psychological stress. It's also important to consider the social dimension of this topic. Conversations about gold and silver often attract extreme viewpoints, ranging from outright dismissal to obsessive focus. Neither extreme is helpful. Metals are tools, not identities. They are part of a broader strategy, not a replacement for it. Maintaining that perspective helps prevent emotional overinvestment and disappointment. As 2026 approaches, the question is less about whether the financial system will continue to function and more about how it will function and who it will favor. Systems under stress tend to benefit debtors, institutions, and those closest to policy levers, while savers and wage earners often bear the cost. Gold and silver provide a way to opt out of that dynamic if held in sufficient quantity to make a difference. Ultimately, enough is the amount that allows you to sleep at night while remaining financially flexible. It is the portion that could meaningfully offset a decline in purchasing power without forcing you to sacrifice liquidity or opportunity. It is not a number someone else hands you. It is a range you determine through honest assessment of risk, goals, and temperament. The most important takeaway is this: preparation is not about predicting disaster. It is about acknowledging uncertainty. Gold and silver are not baits on collapse, they are acknowledgments of limits to debt, limits to policy, limits to trust. As those limits become increasingly visible, the role of tangible monetary assets becomes clearer. If you've been focused exclusively on silver's price movements or gold's headlines, this broader perspective is essential. The real question is not what metals will do next week or next month, but whether your financial structure is resilient enough to handle multiple scenarios without forcing reactive decisions. That is what enough truly means. As we move toward 2026, the people who fare best will not be those who guessed perfectly, but those who positioned thoughtfully, sized their exposure appropriately, and maintained discipline. Gold and silver are tools to support that discipline, not shortcuts. Used wisely, they provide stability in an unstable world. Used carelessly, they can become another source of stress. The window to think clearly is always before urgency takes over. That window is still open, but it won't stay open forever. Preparing while conditions are relatively calm is far easier than scrambling when they are not. The goal is not alarmism, it is realism.